Welcome. It's Drew Blazsik with Logos and Markets. And what I want to do, I want to talk about the proposal that President Trump has presented of a 50-year mortgage. Is that beneficial? So let's get right into that. It was reported that President Trump has suggested a 50-year mortgage plan to ease home buying, but financial experts are questioning its viability. So what's the purpose of it? The idea is to lower monthly payments by extending the loan from 30 to 50 years. And then an analyst, so what's the main purpose of it? So you got different variables when it comes to mortgage. I mean, you got the interest rate. Are you doing it monthly payments? You have how long it is as maturity, 15 years, 30 to 50. And then what you have is you have payments. And that's the key. Well, how much does it cost per month? And is it worth it from going to, and we're going to analyze a bunch of different ways. What about 5 to 15 years? What about 30 to 50? And you can go 50 to 100. You can see, is it beneficial through, and what we're going to look at compound interest. Like, how does that affect the total interest you're paying? How does that affect your monthly payments and so on? A little history behind it was the FDR that really promoted the 30-year mortgage that made it more possible for home buyers to say, you know what, without a massive down payment, without working today, I could buy this house, a nicer house than what I could afford today, and have a 30-year mortgage. So let's pull up, I'm going to pull up my Excel sheet here. And what we're going to be looking at, this is something I created. We're going to look at some basic stuff here. So we're just going to take out a $400,000 mortgage. In this example, it's going to be a 30-year loan, 12 payments. And we did a interest rate of 6.22% for the year. So I'm going to show you what is going today. The date is December 12th, 2025. And the going 30-year mortgage is 6.22. And so this would be, just to show some statistics here, your payment would be $24.55. And I believe it's a little more than $400,000 for the average home price. So that's why I'm picking that as a loan. It'll be a little more. And I know that you have to have a down payment, but we're just going to say we're taking a $400,000 loan. Now, it's important with that interest rate. What's great about this, you could change it around. But with that interest rate, you're going to pay for the life of the loan, which means if you pay the minimum payments for 30 years, you would pay a total of $483,000. So you're going to pay more in interest than you are with the house. So before we get to this data, just show you a couple things. If I go to 4%, look how much that drops. You're going to be paying $287,000 total interest. That's less than the actual loan by a pretty large number. 4% isn't a hard number to believe because we had at our home, we bought it in 2019. I believe we paid around 4 or 3.85, I remember correctly. Some people got a 3%. Look how much that drops. So the interest rate is very important. So let's go back to the market rate, 6.22. And I just want to show you before we show the data, you can get a 15 or a 30. If you got a 15-year mortgage, your payments jump roughly $1,000 a month, and you are paying a lot less in interest. So 216,000. So it's about $1,000 extra a month, but you're paying a lot more in interest. So again, it's the trade-off. What's more important? In the short term, you could have that house you wanted, but the payments will be, this is from a 15 to a 30. So it's a lot different than what we're going to look at. The payments will be lower going from a 15 to a 30, but you're going to pay, the trade-off is a lot more interest. So the question before we show the data, I want to ask, what do you think the banks want? What would Wall Street want? Would they want you to have 10-year loans, 15-year loans to buy a house? Well, two things which would happen. They wouldn't have the mortgage-backed securities to show investors that this is the total valuation of this package because you're going to pay a lot less interest overall. Number one. Number two, this is if let's go back to the 15. I want you to think about it. If we went to a 15, you're paying 1,000 extra a month, which means you probably cannot purchase that house. You're going to have to live in a smaller house or rent property until you save enough for a down payment to buy the house. So, what is the impact of the price of houses? It would bring the price down. So that's the trade-off. Everyone could buy a nicer house, but the demand goes up and the price goes up. But if you lower that maturity, it's important to see that the payments go up, but the demand would go down. Therefore, the price value would drop. It'd be more affordable, but not as many people would have big houses. One thing to think about. So let's go to the sensitivity analysis here. I'm going to change. No, this is correct. So let's go to just to show you real quick. I went to the Federal Reserve. A 30-year mortgage is 6.22% for a 30-year, and that's what we'll go by. And then a 15-year, if you got that, is 5.54%. Why do we have a difference? It's because when you have a shorter term loan, so 15 instead of 30, you're considered less risk to the bank because there's a greater chance, a bunch of ways you could look at it, but there's a greater chance you will go bank or foreclose on your property within 30 years and then 15. But then you ask yourself, well, the payments are higher. Well, you have to qualify for those payments. The banks will look at it and say, are you making enough for those payments? If you're making enough, now it has to do with the duration of the loan. The longer it is, the more risky, and you always pay a higher interest rate to accommodate the borrower or the lender of that risk. So in our Excel sheet, I have 5.54. So we can go over the numbers here. 6.22. Um, our This is based on a 30. Oh, this is based on a 15. I'm gonna go back to our. I'm gonna change that to a 30. What I wanted to go because that's what we're gonna look at. So I want to show you the difference in the numbers here. Um, This is based off a 30-year mortgage. That's the difference in price based on those interest rates. So that's, I guess, not important with this conversation, but I just want to show you what this Excel sheet will show. And then we got something called the BMR. And you might ask, what is the BMR? It's an index. Well, I created this index. This index is called the Blazsik Maturity Ratio. And what it is, and I'll show you the one down here because we want to look at the maturity sensitivity between the two is the Blazsik maturity ratio. All it is from if you have two different mortgages, we got a right down here, we got a 30 and a 50, or two different interest rates. I want to know the change of total interest. Here's the different interest that we had, right? You're going to pay a total interest more on the higher interest rate, and I'm going to divide it by the change in PMT payments. So what would this say? This means for every $1 of a decline in your payment, you are paying a total of $360 of total interest. So it shows you that ratio. If that ratio is going up, it's costing you for every $1 decline in your payment, it's going to cost you that amount of total interest. Now, we are assuming that the life of the loan is going to be paid minimum payments for 30 years, which we know the average home buyer typically, I've seen different numbers, we'll say 8 to 12 years when you sell your house. Some people say 7. All right, so let's get more into its specifics. So I got these interest rates important. That's a 15, that's a 30. And now I got two different maturities. Oh, I don't want me to do that. Let's go to a 15 and a 30. And now what we can do is we can compare. We're doubling the maturity. That's a 100% increase. The BMR index, which says for every, so what we're doing is, why do you increase your the years of the life of the loan? Is because you want a lower payment. So for every $1 you're lowering your payment, you're paying an additional, and that's $1 per month. You're paying an additional $325 or $326 of total interest. So that's what it's costing you from a 15 to a 30. So we can see the first data I showed, on the first sheet, I said, look when we went from a 15 to a 30, but I did not take into account the different interest rate, because when you go from a 15 to a 30, a 15 will have a lower interest rate. So that will help that. So we can see it's a decline. You save from going to a 15 to a 30, $822. So you can say, you know what? That might be worth it. That's what the people in the FDR administration is probably looking at and saying, if you could decline it by that amount, which means all those people earning X dollars per year would qualify for this loan. If not, if we had to go to the 3276, you would need to make a certain amount of money in order to pay that, which means if you couldn't do it, you have to save on it. And then there's a difference in total interest. So again, there's a change of interest, 267, and there's the decline of our payment. So I took that value divided by that value, that's 325. So every $1 decline in payment, you're paying $325 in interest. So it shows the payoff between that. So let's just do a couple values here. I'm going to keep those interest rates the same for now, but we cannot make those assumptions if we go to a 50. But let's just go from a 5 to a 10. So this is what I want to show you. If you do the shorter maturity for a loan from 5 to a 10, look how much that changes. That's a decline of $3,163. If you go from a 5 to a 15, look how much it declines. It declines by $42.25. And now, of course, there is no 5, but there used to be 5-year mortgages, right? You had to pay it off very quickly. You had to have I think way back in the day, we're not talking about too far back, but before the FDR administration, you would have to have, say, land and the property was, say, $10,000. You would have to have $5,000 down payment, and then you could do the rest. Now, you think about that. You're not going to have as much speculation if you have a massive down payment, and you're not. Banks won't have to worry about people foreclosing as much because you have a massive down payment. And another thing to think about with banks is that the least amount of risk is a collateralized loan. You always have the property, and what they do, they kick you off the property, they take your house. The bank never owned the property before that. Now they do. So once you get that loan, you don't make the payment. Now the banks actually own the property. So it's really a very good risk. I won't say riskless, like a government security, but it's very minimal risk. All right, let's get back to it. So what we're going to do is let's make a couple assumptions here. I'm going to go from a 30 and we're going to look at it to a 50. I'm going to show you why this is a massive difference than from a 5 to a 10 or a 15 to a 30. Now I'm going to go from the base rate, what was it, 6.22. Now, one thing you have to keep in mind, if you go from 6.22 and then we go to a 50, you are absolutely more risky. I did my math behind it. I said, okay, I think the it should be 6.75. I asked ChatGPT, I said, given these circumstances, given the 15 and 30, what would be your assumption for a 50 year? And it said the same result. I came up with 6.75. It gave a high number of 7. It could. I would argue, now think about this, is 50-year mortgages is getting close to the end of your life. If you're 30 years old, you get a 50-year mortgage, you're going to be 80. I would argue there's more risk involved that you will not pay it off, and the interest rate might be a little higher. Now, all I did was take a conservative change from a 15 to a 30 to a 30 to a 50. So we'll say 6.75. So this is what I want to show you, and this is my take on it, is that you can argue a 15 to a 30. You can argue that. And I would say, you have a great point. I would say that's going to jack up home prices. That's going to make it, it makes it easier for everyone to buy, but home prices will go up. If you want home prices to be cheaper and you want to have a nation of savers, you only have 15, 10-year mortgages. But I'll say, you know what? You bring up a good point because you save $800 per month, and that's going to open up a lot of people and benefit. But look at this. If you go up to a 6.22 to a 6.75 interest rate, and now we have a 30 and a 50, you save $125. $125 per month. So why would a 15 to a 30 and then a 30 to a 50? And I'll address that in a second. Look at the total interest you're paying. Is this good for society? The banks absolutely love this. You were going to pay $483,000. Now you're paying almost a million, 902,000 bucks off of this interest rate, 32 of 50. 125, look at the BMR. For every $1 you're saving per month, every $1, if you hold it to the life of the 50 years, you are paying for that $1 deduction $3,361 extra of interest. That is the index that shows the cost of each dollar you're minimizing. Hey, I teach Catholic economics. That does not seem smart. That does not seem like a good thing for a family. And more than likely, you're going to be dying your deathbed, passing on this debt to your children. I don't think that's a good thing. And a lot of times they'll just try to sell it and you're going to put that burden on them. There's nothing more beautiful than having property owned by the parents, by the father. And what we do with that money is we pass it to our kids and then they own the property. Um, so I want to show that. So that BMR is off the charts. I'm going to show you a couple more examples. I'm not going to show the interest rate, but I am going to show this is a graph of payments to maturity. And if you notice by this graph, and this is a good visualization to see how this looks, and I'm basing it off the 6.22 and the 6.75 interest rate. When you start at 5 years and you go to 15, that payment drops dramatically. When you go from a 15 to a 30, it's leveling off, but it still drops and you save 800 bucks like we showed. But look what happens as you increase the maturity each time, that payments level off and eventually you'll see no change. So my answer to President Trump is not just that debt is a bad thing for families, it's a bad thing for society, it's a bad thing to always have this massive debt holding over your head and you're going to pass it to your children. That's a horrible thing. Not just that, there is absolutely hardly any benefit to it. You're sacrificing all that interest to the bank. 418,000. The addition to that mortgage is more interest. Just the change of that mortgage from a 30 to 50, the additional interest paid is more than the actual loan itself, right? It was $400,000. The addition to it was more, let alone the initial interest is more as well. So again, that costs way too much. You're saving $125. Don't do it. So like I said, and I'll explain why. And I'm going to show a couple more examples here. But uh, it's not a good thing to have this kind of debt, and there's hardly any benefit. The cost outweighs the benefit by a long shot in that example. All right, so I want to show this. This is pretty crazy, and I'll explain compound interest in these loans. So let's go from a 50 to a 100 year. So you ask yourself, well, what is my payments going to change? It changes by $82. I doubled the maturity from 50 to 100. It changes by 82. What if I change it to 1,000 years? I declined it by $79. What if I change it from 100 years to 1,000? You change it by 172. So it shows that it benefit really doesn't benefit that much. Now you might be asking, those numbers seem kind of crazy. Why, when you go such a long loan, why doesn't it really change by much? Like if you go from 70 to 100, that does drop it to 152. So you get a little bit of a change there. So why from those numbers, 50 to 100 changes it by less than 70 to 100? It has to do with compound interest. That's the key. Compound interest, and I don't know if this is true, but I always heard that Einstein said it's one of the wonders of the world. It's the most powerful force of the universe. You see that online. I don't know if he said it, but compound interest is a very powerful thing. Is that when you increase that years, that maturity for a loan, well, why don't the payments change by that much? Is because there's a certain year where compound interest really takes hold. And you could see it by this graph down here. This is the total graph, and it's upward sloping, so it's exponential. That there's a certain point that compound interest really takes. Now let's think about it. If you had a $400,000 loan and you extended it to 100 years, what that's doing, that's going to say, well, yeah, your payments are going to decline by a little bit is because you got to make up all the compound interest. Compound interest is a very powerful thing. And look at that. 100-year loan, you're paying over 2 million in interest. So therefore, the interest is just going to skyrocket if it's past a certain point. Now, typically you say 30 years. Some people would argue different, but once you extend it past that point, you'll see compound interest explode. Therefore, that's why the payments don't change by much, is because you have to pay back the principal and interest. Um, and that's the reason for it. So 50 to 100, look at that. It declines by that amount. And for every $1 decline of your payment, you are paying $14,565 of total interest. So it shows is not worth it. Um, and it's definitely something that we should fight against. Now let me take the moral aspect of this and kind of talk about why I think debt can be a bad thing. And this is more of a spirituality aspect. Is that if you look at money and you could, let's say you have a 10-year-old kid and you're going to pay him $50 to do yard work, and let's say he's going to rake, he's going to mow, he's going to do a bunch of stuff. Do this with him. Say, I'm going to pay you the $50 up front, but tomorrow you're going to have to work. I guarantee he wakes up the next day, he enjoy that $50. He might have went to the store, and now he has to pay, he has to work for that money. He's gonna go, oh, do I have to? It's not gonna be enjoyable work. Do the flip side. You go to your son and say, you know what? I'm gonna pay you $50. If you do the work, I'll pay you afterwards. If he needed that $50, he's gonna jump up, be excited. I've done this all the time. He's gonna be excited, and what he's gonna do is he's gonna go directly um, he's going to go right into it and be happy about it and more joyful. If you pay someone up front, it's going to be harder to do the work later. If you pay him afterwards, and that's why we pay contractors typically afterwards, for a couple of reasons. It makes your work more enjoyable. That's number one. Now think about debt, and this is why I'm a huge proponent. Now I know our monetary system kind of devalues savings. It keeps interest rates low, number one. Number two is if prices are going to rise over time, it makes sense to buy the house today. We bought our house in 2019. Our house went up by more than $100,000, the value that it was in 19 that it is today. That means if I waited, if I lived at, let's say, I rented a property or did something else or lived at our parent law house, or if I did something like that, uh, I would have had to pay a lot more money for the house. So a lot of people say, you know what, go in debt today because prices are going up. So I totally understand that our monetary system promotes debt. Now, let's go into that really quick and I'll explain the spirituality behind it. Is that uh, if you have a devaluing dollar, which we have over time, it's been devalued greatly since the Federal Reserve and especially since 1971, it's been going down in value. That promotes debt because you want to buy assets today before the price goes up because your dollar won't be as worth as much. And if you don't have the money today, you need to borrow to get it. Now let's look at the flip side. Let's say Bitcoin and gold. They appreciate typically they appreciate over time. Is that a good currency? That promotes hoarding. If you had Bitcoin, you're like, why would I spend it today? It's going to go up in value. So it does the opposite than what the devaluing dollar does. If you had a currency that was flat, then that would be, when I mean flat, it just does not change. If you look at the dollar in the 1800s and you go to the 1880s, it looks like that income you earned in 1820 would pay the same because it's based on gold. That's an important distinction between it. Now, what's my point about debt? Is that if you want that thing, if you want that car, and they go, hey, you don't even have to have a down payment. If you want that house, if you want that Xbox, before you work and you labor for something and you get it without work, that's debt. Um, you're thinking of the immediacy, you're thinking of today, and you're not thinking about what works hard for tomorrow. If you're a saver, you work hard and you have a goal. what you're going to do with that money. And when you're working, you know the purpose of work, and you're saving and you're buying it. Now, you have two approaches there. If you go in debt, you never earned that money. You just went in debt and you purchased it. You don't appreciate the asset. If you had to work for 10 years and you purchase something, you appreciate it more. That's number one. Number two, if you have an immediacy mindset, you're thinking of the here and now without hard work. If you think of saving, like for example, children are a great example. Children are a blessing and a great thing, but they are hard. And the goal of, as a Catholic, is to get them to heaven. Therefore, this is hard, and the benefit is in the eternal life. So, saving naturally and spiritually creates a mindset for the future, for eternity. Debt promotes immediacy today without the hard work for today. And you don't think about the future as much. Um, so it's real important that we reject this 50-year mortgage. And it's real important that us as citizens that we try, and I think this is very important, is we do things like, for example, a car. We save money per month for a car. And let's say you have a great car. You know you're going to buy one in 10 years, 5 years, whatever it is. Put $500 aside, start saving. You'll appreciate it. You'll have a massive amount of money in that time period. You can put a down payment, or you could buy the car outright, get a used car, and I guarantee you'll appreciate it. You'll appreciate the work more. You'll appreciate the asset more. There you go. Thank you for listening. This is Drew Blazsik, Logos and Markets. If you're interested about my Excel sheet, I just want to show you one more thing really quick. I'll be more than willing to send it to you. I really love building these. And on my Excel sheet, this is a very advanced formula. I put down, well, what happens if you put an extra $100 per month, and you can see exactly, is that a smart decision? And you can see, oh, that gave you an effective yield of 3.97. So it's very advanced. Or what you could do is, well, I said you sell your house within 10 years. What if you sell the house within, let's say, 2 years, 24 months? Well, that really, the effective yield, if you sold it 10 years, in 2 years, and you put $100 per month for those 2 years, you only really gained 3.05%. So if you like something like this is very insightful. This will show you what are you actually making if you sell the house sooner, and where should you put your money in. I can send to, and you can do specific months. I could say, what if I had a $9 investment, and it'll show what the return would be. Again, this is Drew Blazsik, Logos and Markets. Appreciate it. And until next time, I will see you.